Friends, welcome back to my YouTube channel. I am Manoj. I am currently pursuing my MBA in Sri Venkateswara College of Engineering, Bengaluru, which is affiliated with VTU Belagavi. This video is a part of financial management, and the content is what is equity share and types of equity shares. So what is equity share? Equity shares, it is also known as ordinary shares, which represents a unit of ownership in a company. When an investors purchase equity shares, they become a part owner of the company with a claim on its profits and also assets. Equity shareholders have voting rights in the company of annual general meetings, and also they can influence major decisions such as electing the board of directors or approving the mergers and acquisitions. These shares are traded on stock exchange, and their prices will fluctuate based on the company's performance, market trends, and also investors' sentiment. The primary benefits of the holding of equity shares, it includes potential capital appreciation and also dividend income. So dividends are the portions of a company earnings which is distributed to the shareholders, usually in the form of cash or additional shares. So investors can buy and sell equity shares through a demat account online, which facilitates the electronic storage and transfer of securities. This modern method of holding shares, which eliminates the risk associated with the physical share certificates, and also it makes trading more efficient. So types of equity shares: authorized shares, issued shares, subscribed shares, paid up shares, bonus shares, right shares, sweat equity shares, and preference shares. So first equity share is authorized share. So these authorized shares, it refers to the maximum number of shares of a company which is legally permitted to issue as per its corporate character. So this number of decided when the company is incorporated, and it can be increased later with shareholders approval. Authorized shares are not necessarily issued to the public. They simply set the upper limit of the shares of the company which can be distributed. For example, a company may have authorized capital of 10 million shares, but they may choose to issue only 5 million shares to raise the funds. So the remaining 5 million shares will remain authorized but unissued, so giving the company flexibility to issue more shares in the future for expansion or for other purpose. So second is issued shares. These issued shares are a subset of authorized shares which is distributed to the shareholders, including the public, company insiders, and also institutional investors. These shares represents actual ownership in the company and can be traded on the stock exchanges. For instance, if a company has authorized 10 million shares and issued only 5 million shares, investors currently hold 5 million shares. So the company can issue more shares from its authorized capital if it needs to raise the additional funds. So third is subscribed shares. So these subscribed shares are those that investors have committed to purchasing during an initial public offerings, which is called as IPO or a right issue. The company issues these shares to the investors who have subscribed, indicating their interest in owning part of the company. For example, during an IPO, if a company offers 5 million shares and a investor subscribe to all of them, these 5 million shares become subscribed shares, representing the commitment of investors to buy them. And paid up shares. These paid up shares are the portion of the subscribed shares of which the investors have fully paid the subscription price. So these shares represents the capital shareholders invest and also reflect on the company's balance sheet. If a company issues 5 million shares at each 10 and investors pay the full amount, these 5 million shares are considered paid up capital, and the company can then use this capital for its business operations and also for development and also for growth. And bonus shares. These bonus shares are distributed to existing shareholders without additional cost. So based on the number of shares already owned by the individual, the company issue bonus shares from their free reserve to reward the shareholders and also increase the liquidity of their shares. For example, if a company might declare a 1:1 bonus issue, meaning shareholders receive one additional share for every share they hold. So if an investor owns 100 shares, they would receive 100 bonus shares, doubling their total holdings to 200. So right issue. This right issue which is offered to the existing shareholders at a discounted price before they were offered to the public. So this allows the current shareholders to maintain their proportional ownership in the company. So these right issues typically raise additional capital for growth and debt reduction. For example, if a company might offer a right issue of one share for every 5 shares held at a 20% discount to the current market price. So if an investor owns 500 shares, then they can purchase an additional 100 at a discount price. So sweat equity shares. These sweat equity shares are issued to the employees or directors of a company as a reward for their contributions to the company, such as providing technical expertise or innovative ideas to the company. And these shares serve as an incentive for a key personnel to continue contributing to the company's success. So for example, a technology company might issue the sweat equity shares to its lead developer for creating a groundbreaking software product. So these shares can be motivate employees to remain with the companies and align their interest with those of shareholders. So preference shares. Although preference shares are not strictly equity shares, these preference shares are often categorized under equity due to their hybrid nature. So these preference shares receive fixed dividends before equity shareholders and have a higher claim on assets in case of liquidation. However, they usually do not have any voting rights in the company. For example, a company might issue preference shares with a 5% annual dividend. So the preference shares receive this fixed dividend before the equity shareholders. These dividends are paid to the equity shareholders after the preference shareholders get. So in this event of a company liquidation, the preference shareholders are paid out before equity shareholders. And this is the end of the video, and thank you everyone for watching this video. Please like my video and subscribe my channel. Thank you.